Most people treat their credit score like a mysterious number, something they check once in a while but don't fully understand. Yet this three-digit number can dictate your financial future, affecting loans, credit cards, mortgages, and even job applications. In this video, we'll explain exactly what affects your credit score, which factors matter most, and how to improve it fast, all in 10 minutes. No fluff, no complicated jargon, just actionable insights. By the end, you'll know how credit works, what really moves the needle, and what myths to ignore. Let's dive in. Section 1. What is a credit score? Your credit score is more than a number. It's a financial reputation that lenders rely on to make decisions about you. A credit score is a three-digit number, typically ranging from 300 to 850, that represents how responsibly you manage credit. Lenders, landlords, insurers, and even some employers look at this number to judge your financial reliability. The most commonly used model in the US is the FICO score. While there are other models like Vantage Score, FICO remains the dominant standard used by most lenders. Imagine two people. One has a 750 credit score. Low risk, easy loan approvals, and lower interest rates. The other has a 620 score, higher risk, fewer loan options, and more expensive borrowing costs. That difference can easily translate into thousands of dollars over the life of a mortgage, car loan, or student loan. So what makes up this score? That's where most people get confused. The 5 credit score factors. Not all credit score components are created equal. 2 factors dominate the entire calculation. Credit scores, especially the FICO model, are calculated using 5 main factors. Payment history, 35%. Credit utilization, 30%. Length of credit history, 15%. Credit mix, 10%. New credit inquiries, 10%. This means that nearly 2/3 of your score depends on just 2 things: whether you pay on time and how much of your available credit you're using. Understanding this is the first step toward real improvement. Payment history. A single missed payment can derail your credit score for years. Payment history, or whether you've paid bills on time, is the most influential factor in your credit score, accounting for roughly 35% of your total score. Late payments, defaults, collections, and bankruptcies can all pull your score down rapidly. Even one late payment that's reported to credit bureaus can remain on your record for up to 7 years. That means a momentary slip could affect your finances long into the future. Real-world example. If you're applying for a mortgage and you miss a credit card payment by 30 days just before your application, your score could drop enough to push you into a higher interest tier, costing thousands more over the life of your loan. Actionable tip. Set up automatic payments for all recurring bills. Use calendar reminders for manual payments. These small changes drastically reduce the risk of missing a due date. Once you're paying on time, the next big driver of your score is how much credit you're using. Credit utilization. How much you're using. Using too much of your available credit sends a red flag to lenders, even if you pay on time. Credit utilization measures the percentage of your total credit limit that you're currently using. This accounts for about 30% of your score, nearly as important as payment history. Here's how it works. If your limit is $10,000 and you're using $3,000, your utilization rate is 30%. Experts recommend staying below 30% and below 10% if you want the strongest scores. High utilization signals financial stress. Lenders interpret this as you relying heavily on borrowed money, which suggests higher risk. Example: 2 people both have perfect payment history, but one uses 80% of their credit limit each month, while the other uses just 10%. The person with lower utilization will almost always have a better credit score. Actionable tip. Pay down balances before the statement closing dates so lower balances report to the bureaus. Spread balances across cards instead of maxing out one. With utilization under control, your next focus should be history. How long you've had credit. Length of credit history. age matters. Older credit accounts are like veteran references. They build credibility over time. The length of your credit history accounts for about 15% of your score. This factor considers the age of your oldest account, the age of your newest account, the average age of all accounts. Why it matters? A longer history gives lenders a larger data set to assess your behavior over time. Example, if you opened your first credit card at 22 and it's still open at 32, that decade of activity shows stability. Closing that old card reduces your average age and can hurt your score even if you no longer use it. Actionable tip: keep older accounts open, especially if they don't have annual fees. Now let's talk about the parts that matter less but still count. Credit mix and new credit 20% combined. Variety helps, but only after you master the basics. Credit mix 10%. Having different types of credit cards, auto loans, student loans, mortgages, tells lenders you can manage various credit responsibilities. Example, someone with a credit card and an auto loan may score slightly better than someone with only a card, all else equal, because it shows experience with both revolving and installment credit. New credit inquiries 10%. Every time you apply for credit, lenders run a hard inquiry, which can temporarily lower your score by a few points. Tip: limit new credit applications. Rate shop for major loans like mortgages or auto loans. Within a short window, most scoring models count multiple inquiries for the same loan type as one. Now that you understand what affects your score, let's clear up some common myths that waste time and money. Credit score ranges and real-world impact. Small changes in your score aren't just numbers, they influence real costs. Here are common FICO score tiers: 300 to 579 poor, 580 to 669 fair, 670 to 739 good, 740 to 799 very good, 800 to 850 excellent. Real-world example: mortgage rates. A credit score of 760 plus often qualifies for the lowest mortgage rates, while a score around 620 TP 650 may still get a loan but at significantly higher interest costs. A difference of even 0.5% on a long-term mortgage can cost tens of thousands of dollars over a 30-year term. This isn't limited to mortgages. Auto loans, credit card offers, insurance premiums, and sometimes even job screenings can be affected by your credit score. Quick actions to improve your credit in 2026. You don't need years to see improvement. Some changes reflect in weeks. 1. Pay bills on time. Every time. Even small delays impact payment history. 2. Reduce your credit utilization by paying down balances and keeping usage below 30%, or even below 10% if possible. 3. Keep old accounts open. This strengthens your length of credit history. 4. Avoid opening too many new accounts at once. Too many inquiries signal risk. 5. Regularly check your credit reports for errors. Unexpected negative items can be disputed and removed if inaccurate. 6. Stay patient. Good habits compound over time, just like interest. Your credit score is one of the most powerful financial tools you have, and once you understand what really matters, you can take control rather than guessing or hoping for the best. Focus on the two biggest drivers, payment history and credit utilization first, and everything else will fall into place. If this video helped you finally understand credit scores, like it, comment on your credit goal for 2026, and subscribe for more practical financial insights you can use right away.